Picture this. It's October 29th, 1929, a regular Tuesday morning in New York City. But on Wall Street, something is happening that will change the world forever. Thousands of people are rushing toward the stock exchange, panic written all over their faces. Inside the building, stockbrokers are shouting, phones are ringing nonstop, and grown men are crying. By the end of the day, billions of dollars will simply vanish into thin air. This is the story of the worst stock market crash in American history. And honestly, it's kind of wild how it all happened. Now, before we dive into the chaos, let's rewind a bit. Imagine walking into a candy store with $5. That candy store is the stock market, and your $5 is your investment money. When you buy candy, you're hoping it tastes good. When you buy stocks, you're hoping the company does well, and your $5 turns into $10 or maybe even $20. That's basically how stocks work. You buy a tiny piece of a company, and if that company makes money, you make money too. In the 1920s, America was having an absolute party. The First World War had just ended, new technologies were popping up everywhere, and people were feeling optimistic about the future. Cars were rolling off assembly lines, radios were in living rooms, and electric appliances were making life easier. Companies were making tons of money, and their stock prices were climbing higher and higher. Everyone wanted a piece of the action. Here's where things get interesting. Ordinary people, not just rich folks, started buying stocks like crazy. Your neighbor, the local shopkeeper, even factory workers were putting their money into the stock market. And why wouldn't they? Stocks were going up, up, up. It seemed like free money. People were literally quitting their jobs to become day traders because they thought they'd found the secret to getting rich quick. But there was a catch. Most people didn't actually have enough money to buy stocks, so the banks came up with a clever idea called buying on margin. Think of it like this. You want to buy $10 worth of candy, but you only have $1. The bank says, no problem, we'll lend you the other $9. You can pay us later when you sell that candy for $20. Sounds great, right? Well, it only works if the candy actually sells for more than you paid. Thousands of people were borrowing money to buy stocks, convinced that prices would keep rising forever. Some folks were borrowing up to 90% of the stock price. That means if someone bought a $100 stock, they only paid $10 of their own money. The rest was borrowed. The math seemed simple. When that stock hits $200, sell it, pay back the loan, and pocket a huge profit. What could possibly go wrong? Everything, as it turns out. By the late summer of 1929, some smart investors started noticing something odd. Company profits weren't actually matching the crazy high stock prices. It was like everyone agreed that a candy bar worth $1 should actually cost $10, just because. That doesn't make any logical sense, but when everyone believes it, it becomes reality. Until it doesn't. In September 1929, stock prices started wobbling. Nothing dramatic at first, just small dips here and there. Some investors got nervous and started selling their stocks. When they sold, prices dropped a little more. Then more people got nervous and sold. Prices dropped even further. It was like watching dominoes fall, one after another, slowly at first, then faster and faster. October 24th came around. This day got nicknamed Black Thursday, and yeah, it was as bad as it sounds. Stock prices started dropping fast, really fast. Panic spread through Wall Street like wildfire. Investors were desperately trying to sell their stocks before they became worthless. But here's the problem. When everyone wants to sell and nobody wants to buy, prices collapse completely. Remember that margin buying we talked about? This is where it became a nightmare. Let's say someone bought that $100 stock with only $10 of their own money. Now the stock is worth $50. The bank calls them up and says, hey, you owe us money right now. Either put in more cash or we're selling your stock. This is called a margin call, and it happened to thousands of people all at once. People couldn't come up with the extra cash because they'd already put everything into stocks, so the banks forcibly sold their stocks, which pushed prices down even more. This created a vicious cycle. Falling prices led to margin calls. Margin calls led to forced selling, and forced selling led to even lower prices. It was like a snowball rolling down a mountain, getting bigger and faster with every second. Some wealthy bankers tried to stop the bleeding on Black Thursday. They pooled their money together and started buying stocks, trying to convince everyone that things were fine. It worked for a few days.
Prices stabilized a bit, and some people breathed a sigh of relief. Maybe the worst was over. They were wrong, so incredibly wrong. October 29th, 1929, Black Tuesday. This was the big one, the day everything fell apart. More than 16 million shares were traded that day, which was an absolutely insane number back then. To put it in perspective, that was almost 4 times the normal trading volume. Everyone was selling, nobody was buying. Stock prices didn't just fall, they plummeted off a cliff.
By the end of Black Tuesday, the stock market had lost billions of dollars in value. Not millions, billions. Fortunes that took years to build disappeared in hours. People who were millionaires in the morning were broke by dinner time. The panic was so intense that the police had to be called in to control the crowds outside the stock exchange. Now here's the really sad part. This wasn't just about rich people losing money. Ordinary families had put their life savings into stocks. Teachers, nurses, small business owners, retirees, people who trusted that the market would make their future secure. All of that money was gone, just gone. But the crash wasn't even the worst part. What came next was worse, much worse. The stock market crash was like pushing over the first domino in a very long line. Banks had also invested heavily in the stock market, and when it crashed, many banks went bankrupt. When banks fail, people lose their savings. Even people who never bought a single stock lost everything because their bank collapsed. As banks failed, they stopped lending money. Businesses couldn't get loans to operate, so they shut down. When businesses closed, people lost their jobs. Unemployed people couldn't buy things, so more businesses failed, creating even more unemployment. This downward spiral became known as the Great Depression, and it lasted for about 10 years. At its worst, 1 out of every 4 Americans was unemployed. Families lost their homes. People stood in long lines just to get a bowl of soup. The optimism and prosperity of the Roaring '20s had turned into desperate poverty almost overnight. And it wasn't just America. The crash sent shockwaves around the world, affecting economies in Europe, Asia, and beyond. So what caused all of this? Well, it wasn't just one thing. It was a perfect storm of problems. Stock prices had risen way too high, far beyond what companies were actually worth. Too many people were buying on borrowed money, creating a house of cards waiting to collapse. Banks were making risky investments without proper safeguards, and there was almost no government regulation to prevent any of this madness. The crash taught the world some hard lessons. The government created new rules to protect investors and regulate the stock market. The Securities and Exchange Commission was born to police Wall Street and prevent fraud. Laws were passed to protect bank deposits and limit risky speculation. These safeguards are still in place today, helping to prevent another disaster on this scale. But here's the thing about history. The lessons are only valuable if people remember them. The 1929 crash happened because people got greedy and convinced themselves that prices would rise forever. They ignored warning signs and took massive risks with borrowed money. Sound familiar? Throughout history, markets have crashed multiple times when people forget these lessons and repeat the same mistakes. The stock market crash of 1929 reminds us that what goes up can definitely come down, that borrowing money to invest is incredibly risky, that when something seems too good to be true, it probably is, and that financial markets need rules and regulations to protect ordinary people from catastrophic losses. That Tuesday in October changed everything. It shattered the illusion that prosperity was guaranteed and showed how quickly confidence can turn into panic. The crash didn't just destroy wealth, it destroyed lives, dreams, and faith in the system. But from those ashes came stronger protections, smarter regulations, and hopefully wiser investors. The question is, have we really learned the lesson, or are we doomed to repeat history? That's something we're thinking about every time the market starts looking a little too good to be true.